Woo! Do we have a lot to talk about in this week's housing market update? From a credit crunch to a massive $20 trillion commercial real estate, we'll just call it a concern for right now, to the new gold standard. I'm going to go over the biggest stories I'm following and how they relate to the future of the housing market. So let's get started. Hey, for those of you that don't know me, my name is Rick Harrison and I'm a home buying specialist here in Southwest Florida. And on this channel, I bring you the latest tips, tools, and tours to help you decide if this is the right time and place to make your move to paradise. So if that thought's crossed your mind at some point, you're in the right place. So subscribe and stay up to date on our latest information, keeping you ahead of the curve. So things are heating up in the economy this week with more mainstream media starting to cover the cracks that are showing up everywhere, from small and mid-sized banks, commercial real estate, the yield curve, and even politicians are getting in on the action now. So let's dive into the wall of worry first today. The stories that we're going to be looking at today, starting with this one, are all really telling you a story of what's going on in the economy. And it's going to be a little bit brutal to look at all the headlines. But first one, U.S. corporate bankruptcies filings hit 12-year high in the first 2 months of 2023. Also, moving on to the credit crunch. So this is something that you've probably heard something about, and obviously with Silicon Valley Bank crashing and really going bankrupt, it's starting to lead to more questions as to what's going on in the banking industry. So what's really happening right now with the Feds raising the rates, they're raising rates for what banks can lend to each other by. So if the interest rate was at 6%, for example, then that interest rate is what the banks have to lend to each other for. That's just the federal rate. So the federal rate's not at 6% yet, just to clarify. But if it was, then that is what the rate that banks would have to allow each other to borrow to. Why do banks allow each other to borrow money? Because they might not actually have the money in reserves in their bank to make the investments that they need to make, or to give the loans out that they need to give. So if you watch my previous video, which was on where the financial market and where the financial system is heading, I go over that, and you can check that video out right here. So in the last 2 weeks of March, bank lending crashes by the most on record. Banks with less than $250 billion in assets are responsible for about 50% of U.S. commercial and industrial lending, which is going to be a big factor in one of these upcoming stories in a minute. 60% of residential real estate lending, 80% of commercial real estate lending, and 45% of consumer lending. All of those factors are a big part of what's going on with banks right now. And that's, as you can see, it's going to affect all the markets if this does play out, which it looks like it may. As you can see up here at the top, we have the total commercial bank loans and leases rising pretty steadily, except for a couple hiccups here, which is, obviously when we had the shutdown. But then you take a look at the bottom, which is a 2-week change in loans and leases. This means that loans and leases there's not any of them in the market. They're not happening anymore. This goes all the way back through the 70s. And you can see that we haven't hit this low ever in the history. Essentially, nobody's taking out loans or leases for these buildings, for commercial buildings, for industrial buildings. It's at an all-time low in history. Here's another chart just to show you what's going on with the actual reserves in the bank, which I just mentioned. The top one in blue is this the large bank cash reserve. So your Bank of America, your Chase, your JP Morgans, things like that. So they're doing all right. The small banks, the cash reserves are way down, and this is almost at an all-time low as well. So they're right at the constraint of where they can be for the amount of debt that they have out. So going into the actual banking industry with loans, where we're actually looking at the real estate loans, independent mortgage banks and mortgage subsidiaries lost an average of $301 on each loan they originated in 2022. So that's down from an average profit of $23.39. We actually have a $2,600 spread there between what they were making for profit versus what they're now losing. The big thing here is the stellar profits of the previous 2 years dissipated because of the confluence of declining volume, lower revenues, and higher cost per loan. The loans have become more costlier for people to originate. There also has been a loss of the volume because nobody wants to buy with higher interest rates or refinance with higher interest rates. And then you also have the lower revenues because of the higher cost per loan. Next up, apartment building sales dropped 74%, the most in 14 years. So this goes back even to the financial crisis of 2008. Investors purchased $14 billion of apartment buildings in the first quarter of 2023. That represents a 74% decline in sales from the same quarter a year earlier. Going back to 2009, 77% drop was the most. and we're almost there right now. So American offices are half empty. So this starts to tie in all of the stories that we just covered. The U.S. corporate real estate market is a $20 trillion market right now. When these loans were taken out, they don't have a 30-year fixed mortgage for a commercial loan. They have adjustable rate loans. So these loans will mature and then they have to be adjusted based on what's going on with the current interest rates. Well, as you can imagine, when these loans were originated over the last decade, they have had pretty low interest rates. Now they're starting to adjust to the new interest rates, which are also reflective of what the Fed's doing. A lot of these cash flowing properties, especially with apartment buildings and offices being, not being used, whoever owns those buildings, they're going to have a lot of money coming due soon. And they're also going to have less cash flow coming in because of what's going on with all these offices. And that's what's being talked about now and just starting to be looked at as a possibility or potential, but it's really starting to, more and more factors are starting to come to light. Commercial real estate crash that may never happen. Yeah. A lot of the mainstream stories have been saying that none of this stuff was going to happen, and a lot of this stuff is starting to happen, bank failures, etc. Almost a quarter of office building loans need to be refinanced in the next year at higher rates, and lower quality properties where vacancy rates are high are at the greatest risk. There are some reasons to think the road ahead will be rocky for the real estate industry and banks that depend on it. And the stakes, according to Goldman, are high, especially if it is a recession, which we've already been in a recession for a while. I don't know why they aren't admitting it. They just keep changing what is considered a recession. But the credit in commercial real estate has performed well until now, and it's far from clear that the U.S. credit issues spreading outward from real estate is likely. Again, I don't think anybody in mainstream is going to call something really bad way ahead of time because for fear of being wrong, but there are a few people who are calling for it and see it coming. The vacancy rate for office buildings rose to a record high of 18.2%. So let's say the average is 10%, right? Or, it's really been around 5% over the last several years, but let's just say on average, it's around a 10% vacancy rate. You just lost another 10%. So you've doubled the amount of vacancies and you're losing money because your interest is going to be getting jacked up due to the Fed's rates. So you're making less money and you're also going to have to be paying more money. So your cash flow is going to be depleted quite a bit. So this could lead to some really big bankruptcies in the commercial real estate market or sector. And if that does happen, that could spiral out and affect the other markets like residential, because a lot of these investors aren't just investing in commercial, they're also investing in residential, which we've already seen. Redfin, Zillow, all those companies that got rid of their iBuyer programs because they were losing money. Something like that could be happening in this market as well. If that does come to fruition, which it could, one of the things, an opportunity for those of you who are investors, and this could be something you might start looking into now, actually turning those commercial buildings into residential buildings. When I was in Connecticut, a lot of the old manufacturing buildings were actually rehabbed and made into huge apartment buildings. And it was actually pretty cool. That is a need right now. Rentals are scarce. Homes are scarce. So people do need places to stay. The bigger issue right now is the interest rates, and those are going to be coming down. I'll be covering that in just a few minutes. Two really unique stories I thought were pretty cool. And I don't know if you've heard about them or if you've seen this, but I think this is pretty cool, and it could actually gain some momentum, but it's going to be an uphill battle, I think, for these guys. 3 congressmen introduced gold standard bill to stabilize the dollar's value. This would be interesting, but they introduced this pivotal sound money bill that would enable the Federal Reserve note, or dollar, which is what we use now, to regain stable footing for the first time in more than half a century since we were taking off of it back in the 70s with Nixon. If you go back to the gold, when we were taking off the Gold Standard Act, it was actually just a pause. It was supposed to be a pause, but it's turned into a 50-year thing. Upon passage, the U.S. Treasury and Federal Reserve are given 24 months to publicly disclose all gold holdings and gold transactions, after which time the Federal Reserve note dollar would be formally repegged to a fixed weight of gold at its then market price. One of the guys that I watch on YouTube, Rebel Capitalist, some of you probably watch him too, he did a recent video on what gold would be worth compared to the dollar if we took what it's been devalued over the last, century. If you peg the amount of notes that we have, which is over 100 trillion, to how many gold ounces we are supposed to have in the reserve, the price for 1 ounce of gold would be upwards of $350,000. Now, I don't know if that's going to be how this works, But that would be pretty interesting, especially if you have gold or actual physical gold that you hold and not just the trading on the market. That would be very interesting to see. Right in line with that, Texas is actually coming out with the idea of introducing a bill proposing to establish a gold-backed digital currency. So the last video I did was all about where the financial system is going, and I definitely recommend checking that out so you can kind of get an idea of where I think things are heading. But the digital currency is something that's been obviously talked about a lot lately, and Texas is now trying to incorporate the gold pegging through their state. Instead of doing a central-backed digital currency, they're doing a state-backed digital currency. So it gives a little bit more freedom for states to make the rules. But still, with a digital currency, it allows for a universal exchange of some sort. Again, I think, they have an uphill battle to try to implement anything like this against the central banks. So we went over the wall of worry. Now let's move on to our local market updates. First, I wanted to talk about what's going on in the bond market, because right now there's a lot of change going on in the bond market. I've been covering this pretty much every week, but for those of you that aren't familiar, the bond market tells you where mortgage interest rates are going. So if you're a homeowner or a home buyer or somebody who's looking to buy soon, you really want to know where the interest rates are. You just follow the 10-year or the 2-year bond, and that'll pretty much tell you which direction it's heading and by how much. So right here, we're looking at the 10-year bond, and the 10-year bond has taken a huge dive recently. So you can see back in, I believe that was early March, we were at pretty close to the all-time highs again, almost to 7%. And then since then, it's really been declining because of everything that's going on with the banks, the bond market is way bigger than the stock market, and it is usually the one determining where interest rates go. So people are fleeing to try to get to safer havens. And when that happens, yields decline, the mortgage interest rates decline, and that usually is an indicator of what's going on with the Federal Reserve and what their next moves might be. So right now, the bond market, because it's declining, is telling us that the Federal Reserve is very likely, highly likely, and becoming more likely to lower the federal return rate, which means interest rates will come back down. Mortgages will get a little bit easier and cheaper to get again, possibly. But the other side of that coin is when usually when the Fed lowers rates, that's when we enter a recession and things get tough for a while. Now, this is a little bit of a close-up, and I'm not really sure yet. I'm not a financial advisor, but I can't really tell yet if this is a channel or a narrowing wedge. If it's a narrowing wedge, that means at some point, about 80% of the way through the wedge, it will break higher. But this looks more like a channel to me. It just means interest rates are going down. All right, interest rates, as I said, have been going down. 6.85 last time. Now it's down to 6.59, almost 6.6. So it's down 20 basis points. Bank rate has it's actually going up a little bit. I usually take bank rate with a grain of salt. Mortgage applications. So applications actually decreased quite a bit, as you would expect with everything that's going on in the economy right now. People are getting nervous about buying a home, and a lot of people are holding off. Now the actual hyperlocal market from Cape Coral to Naples. New listings went from 1019 last week to 945 this week. That's down 8%. Solds went from 1103 to 778. That's down 30%. And you're going to see these numbers be the same in the northern part of Southwest Florida as well. Pendings went from 1224 down to 1057. That's down 16%. And price decreases actually they're still high, but they're down a little bit. Latest inventory breakdown, single families, we're up 5 this week. So really didn't lose anything. If anything, we're staying pretty steady. Condos still gained 118. So we had a net gain of 466 last week. We have a net gain of 123 this week. Multifamilies just down 4, foreclosures up 1. Those two really haven't been changing much still. And then we got total sales out of the 594 sales. That's single family and condos throughout the last 7 days. 355 of them have been all cash. So that's 59%. Still a high cash market in the southern part. These are the month over month. This is actually month over year statistics. So year over year statistics from March 2023 to March 2022. The biggest increases and decreases here. Active inventory is up 34% year over year. Closed sales is down 15% year over year. So you can see those things are going in the opposite directions. One's going up, one's going down. Median days on market is up 300% from last year. So it's up to 28 days, which is not too bad, really. A month, for a house to be sitting is not that bad. And then new listings is up 1.5% compared to last year. Now, this is month over month. So we're comparing March to February. So this is not this month, but February to March. From February to March, closed sales went up 32%. So we did see quite a few more homes being bought. But that was also because back then we had the interest rates almost at 7%. So when they declined, we started to see more sales happening. Active inventory, 6.1% down. And then new listings up 15.3%. So you can see we are still gaining quite a bit, even month over month, as far as new listings. And I think those numbers are going to be even higher next month. All right, northern part, Punta Gorda up to Sarasota. New listings went from 760 last week to 686. That's down 10%. Really, it's only 80 units, so it's not terrible, but we're not seeing the all-time highs that we were. Solds 994 to 685. That's down 32%. Again, just like the southern part. And then pendings 916 to 848. That's down 8% this week. Price decreases again, almost down the same amount, not 10%, but 12%, which is pretty consistent with the southern part. Latest inventory for the northern part, we had a loss of 53 units in the single family market. And then condos, we saw a gain of 68. So almost a break even here. 242, net gain of 242 last week, though. Now we have a net gain of 15, so pretty close to break even again. Multifamilies up 5, foreclosures up 6. So we are starting to see a little bit more up there. Could be, I mean, we'll have to keep an eye on those numbers because 5 and 6 is it's a pretty good gain week over week. We haven't really seen that much movement in a while. Total sales, 522 over the last 7 days, 279. Or 53% of those were cash sales. And for this market, this is both year over year and month over month. So active listings, the big ones to look out though for the northern part, active listings were up 91% from last year. They were actually down 1% from last month, from February. Listings sold were up 37% from last month. So a lot of people jumped in on the market, same as the southern part of Southwest Florida, because interest rates declined quite a bit very quickly. And then the other one is average sales price. That's up 2% from last month, and that is up 3% from last year. So the market has actually still been appreciating a decent amount. So we've got a lot to keep an eye on, but not to worry. That's exactly what I do on this channel every week. So don't forget to subscribe. And if you're wondering where all this chaos is leading, you might want to check out my previous video that explains my thoughts on the matter right here. And if you have questions, let me know in the comments, or you can call, text, or email me anytime. I'm happy to help in any way I can, and all of my contact information is in the link in the description. Thanks again for watching, and I hope to see you on the next video. But until then, stay safe, stay positive, and more importantly, stay free.